This video and all other videos on this channel for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and we are back with another deep dive, slowly but surely. As far as I can tell, the economic deterioration under the hood continues to get worse and worse and worse. So today, as always, we're going to re-outline the base case hypothesis of the channel that we have held for a couple of years now. Largely speaking, we haven't changed any of it. We have been just observing that the market is slowly but surely playing out in accordance with my expectations. I still maintain 2025 is going to be a wild year. So once again, we're going to run through this thing from the top. I've also got a bunch of new data to show you today, so I'm going to show you that as well. And then, of course, at the end, we'll do what we always do, which is take a look at my live positions that I've got open, TA, and all of that good stuff. And I will let you know how I am positioning as a pro trader ahead of the first quarter of this year. So for the stock market, the base case was pretty simple. At the lows, I thought we were too bearish. We'd have a blow off top to all-time highs. We would see rate cuts sometime around the top, and then we would enter a global recession and a big bear market. Fast forward to today, and you can see the first half of this seems to have played out. We seem to have completed a blow off top. We are now experiencing third and final angle breakdowns, and whilst I currently am hoping that this becomes invalidated, whilst I'm currently hoping the daily cycle low we have found here is going to produce a higher high, if what is observed from here over the coming days and weeks is a second angle violation, then I will have to declare that was the top, and largely speaking, it would have just been part of the base case hypothesis the whole time. So it's a very touchy subject out there to start calling tops, and I'm not quite ready to do so just yet, but under the hood, as you're going to see in a minute, things continue to get worse and worse and worse. So far though, hard to make the case that the first half of this hasn't played out. It's just a question for me at least of, are there more legs left in this, or are we about to see what I fear is coming, which is the second half of this hypothesis play out, which of course would be a bear market and a global recession. There are plenty of warning signs under the hood. Okay, we're seeing things like BlackRock coming out and saying the world economy has exited the boom and bust cycle, just like we saw back right before the dot-com bubble burst. We know for a fact that based on historical levels, no matter which valuation metric you use, the S&P 500, the stock market in general, is very, very expensive, and it's even, based on the price to book, right around the 2000 dot-com bubble levels. If we use the Buffett indicator, okay, we're well above 200%. It's very, very hard to make the case that this is not an expensive market. That doesn't necessarily mean that has to come tumbling down right now, of course. It just means, objectively speaking, we are in an expensive market and we seem to have completed a blow off top, at least for now. For Bitcoin, the base case hypothesis was that we would get an earlier than expected top. This remains to date the one component that did not play ball for me. You can see the schematic down here. This is the current base case that we are working on this fifth wave up to an overthrow of this channel around 150 odd K, and then we will get a Q1 top of this year. As I said, this was the one component that I had to adjust and pivot to new data as it presented itself. I was calling for this to occur from here and then from here initially, and it just took a couple more daily cycles longer than I was expecting. But needless to say, we are now trading comfortably around 100K, which puts us about halfway up this channel. So the big question for me is there another squeeze to the upside left in this thing? And most importantly, can it really top in Q1 of this year? Because if it does, from a 4-year cycle perspective, that implies we have to spend more than the 12 months that we are used to seeing in a bear market for Bitcoin. So far so good. The stock market seems to be moving in the right direction, and Bitcoin, of course, seems to be squeezing up towards 100K. Happy days so far. Now, if we really are going to see true technical breakdowns here, if we really are going to have to entertain the second half of this hypothesis coming to fruition, I have long been making the case that there is no quicker way to kill inflation and move towards a deflationary environment than to have the stock market come tumbling down and force risk to be sold into the short-term safe haven of the dollar, forcing a bid under the dollar, which is how we get deflation. We did a good job for a long time on this channel of successfully calling this move down, sideways and down in CPI and inflation in general. However, of late, we have got an unexpected move to the upside from inflation. I have long been making the case that some of this is to do with shelter. They are using lagging metrics and shelter that is skewing the CPI data. And if we were to use some of these more real-time metrics, then inflation is already well under control. And as I've shown plenty of times before, if we use something like ALNRI, what we actually find is shelter has been deflationary for a year and a half already. But of course, that does not take away from the fact that currently we're seeing another tick up in inflation. And this is causing a big divide and a big area of contention amongst market participants at the moment. Some of the market participants out there are pointing at the fact that we normally do see a quick pop up in CPI and PPI right before we get the stock market breakdown. And of course, as I said earlier, we see risk get sold off into dollars. And once more, I make the case there's no quicker way to kill inflation than to have a big risk-off moment and demand-destroying event. So the question for me is that what we're seeing? A little pop-up before the inevitable resumption to the downside? Or are you in the camp of people that thinks this 1970s double pump inflation fractal is very much in play? I know a lot of people are calling to see a resumption of this and another round of inflation. However, I wanted to point at this because this is actually quite a lazy way of analysing the current inflation data that we have in front of us. To suggest that this inflation backdrop, this inflation fractal is what is currently at play at the moment, completely ignores the fact that this entire second spike in the late 70s was driven by a very distinct and severe supply shock. We had the Iranian Revolution of 78 to 79, which threw the global oil market into chaos. They slashed Iranian oil output by around 4.8 million barrels per day, which was around 7% of the world production at that time. That crisis was then compounded by the Iran and Iraq war, which sent oil prices skyrocketing just shy of 200%, from $13 to $34 a barrel in just 1 year. So that kind of seismic event drove this double-digit inflation, and thus I continue to make the case that it is not acceptable or applicable to use this and say that this is what we are facing today. We have no similar backdrop to this, and therefore I continue to maintain that we have a real risk of deflation here rather than resumption of inflation. Now, with that said, if that is true, then what we should see is a top for inflation and a resumption of disinflation in the very, very near future. If we continue to go the next 2 months and see nothing but upticks in inflation, then I will have to hold my hands up and say that this idea is wrong and invalidated. However, if we do get 1 or 2 more prints followed by a sharp resumption to the downside in the inflation data, particularly as that shelter component starts to catch up with the real world, then once again I will be able to continue to stand with this base case hypothesis that deflation is the risk here, not the resumption of inflation. The next component was, of course, if we're going to have a global bear market and recession, we would obviously expect to see labour market deterioration. Now, this data set for me gets particularly concerning. First of all, we know that we've had a bunch of non-farm payroll data showing that they added jobs in October, and at the same time we've had many other metrics disagreeing, and this has led a bunch of people now to start to question what is actually going on, to start to question the authenticity of this data. And when we make a comparison to things like average employment across all industries, okay, at the hard right edge, this is showing a very recessionary look, just like we've seen in all prior instances. The absolute same is true for manufacturing job openings, which, as you can see, are showing a severely recessionary look. So I continue to make the case that it is just a matter of time before the NBER goes back and paints a grey recessionary bar somewhere across this neighbourhood here. And whilst the Camel Crew has long been speculating, the Fed has been engaging in foul play to try to downplay the severity of the deterioration in the labour market, it seems to me that we can now take this from speculation and conjecture to cold, hard truth. We can see that the government initially reported Q2 of 2024 as having had 653,000 job gains, when just before we're about to have a change of government, it comes out that all of these job gains were actually negative. So it wasn't just that they were covering this up a little bit, they outright lied in the data set. They outright misreported it to make it look like we weren't in a state of recession. And lest we forget, there was also a revision of 800,000 jobs last year, which they falsified the data to help the current government. And now, as I said before, right as they're about to hand this over to a new government, they've suddenly allowed the truth to come out, and suddenly we see that all of that job growth was non-existent. So you can see right here, massive downward revisions continue to happen to the labour market. So once more, the labour market deterioration is even worse than I have been suggesting it is for a very, very long time now. And of course, as people start to lose their jobs, as people start to get laid off at work, they are less able to service the debts such as mortgages, credit cards, auto loans. The most recent round of rate hikes has made all of that debt even tougher to service. So we have the perfect storm here to see the consumer get wrecked. And so far, based on everything I've shown you, the only thing we can point at the moment with a smile on our face is the fact the markets continue to move higher. But again, risk happens fast. It's not going to take long to see something like this. And if we were to get this, the writing is going to have been on the wall for a very, very long time. Things continue to get worse as I present more and more of this data. We also saw the most recent Chicago PMI drop to 36.9 in December. This is the second lowest since the 2020 crisis. Now remember, a read above 50 is indicative of economic expansion, and a read below 50 is indicative of economic contraction. Now this is 100% a recessionary look right here. We are seeing manufacturing all but grind to a halt, just as we've seen in prior recessions. And if we zoom out here, okay, and take a look at this PMI, you can see it's not just the prior 4 examples I showed you, but a whole heap of other recessions as well. Right now, we are in the middle of a recessionary look. We right here have the delinquency rate on commercial mortgage-backed securities for offices jump to a new record of 11%, above that we saw following the GFC. So this commercial real estate crisis is only getting worse. And the same is true of credit card defaults in the US as well. Take a look at this, starting to spike up to the GFC type levels. And this is not intended to be a doom post. This is just me pointing at data, the same data that I've been pointing at every weekend for the past 2 years, hoping that it would slowly but surely improve. okay? But it hasn't. It's just continued to get worse and worse and worse. And as you're about to see, the signal, which for me is the yield curves, is also signaling a recession is closer than ever. So here's the Fed predictions. The reason I want to bring this up is they use the yield curve to price odds of a recession in the next 12 months. Historically speaking, any print over 35 saw a recession within 12 months of that 35% print. At the hard right edge, we reached 61%. Now this has dropped back a little bit. It's currently at 57%, but this is still significantly above the 35% threshold that sees a recession in the not too distant future. Additionally, I've been pointing at this, okay, which is the yield curve. First of all, the 10-2. When we get an inversion, everyone calls for a recession and they are wrong, okay? There's no signal here. When we get a reversion, everyone calls for a recession and once more they are wrong. It is the acceleration, the uptrend of higher highs and higher lows on a weekly time frame that is synonymous with seeing risk-off events and stock market crashes. The same here, okay? Inversion, no need to call it a recession. Reversion, no need to worry. Acceleration, and acceleration leads, of course, to a big plunge in the stock market. We see the same thing here. It's not until we get acceleration in the yield spreads that we see the top come in for the stock market. And so once again, I have long been making the case that all of the doom posters and yield curve recession callers were wrong in here, and they were going to continue to be wrong up until the point where we saw acceleration. But here's where things should start to get a little more concerning. As you can see from my yellow squiggle, okay, we are so far showing the look of an accelerative move, which is defined as higher highs and higher lows on the weekly time frame. It was this yellow squiggle of mine that I was saying, if something like this is to play out, we should really start to entertain major tops being close in the stock market. And I might add all of this occurring on third and final angle breakdowns. Now, it doesn't mean we should necessarily run for the exits just yet. If over the coming weeks what we see here is some kind of reversion to the downside or some kind of bull flagging, okay, then there is no true signal. But if we start to get 2 to 3 to 4 weeks into the future and this continues to print higher highs and higher lows, it will qualify as a recession signal. And I would suggest to you that by the time we get there, we are probably working on this second angle violation right here on the stock market. And note, all of this is occurring at a time when we're hearing things like this is the early stages of a bull market, right? When investors are very, very sure of themselves that this bull market's got plenty of legs ahead. And worse still, people are mocking and jeering and laughing at the people that are using the yield curve. And I think a lot of that is to do with, as I said, people don't actually know how to use this thing for signal. They always are premature to call recessions, and as soon as it reverts above zero, they start panicking and doom posting. And really, like I said a million times, it's the acceleration that we need to watch for. But once more, I make the case that the 10-2 I just showed you is lagging compared to this one, which is the 10-year 3-month yield spread. Now, this one I consider to be the signal because it is much, much, much sharper. The moment this thing starts to accelerate to the upside, the top is already in the dot-com bubble. Okay, the moment this thing starts to accelerate, we already have seen the top for the GFC. And the same is true for the C19 era. By the time this thing started to accelerate, you had very, very little time to react to the C19 plunge. So if I now change this to the 10-year 3-month yield spread and take a look, okay, once again, we are slowly but surely morphing into a potentially accelerative look. Now, it's not yet confirmed, but remember, by the time we get 2 weekly candles with higher high closes in here, we will be rapidly running out of time to start to react to de-risking and deleveraging as this thing starts to break down from a second angle. Now, of course, as ever, with any trade setup, we can see an invalidation here. We could easily continue to see higher highs and higher lows, and if we do that, then we would certainly expect to see, rather than acceleration here in the yield spreads, some kind of bull flagging or even another inversion. If any of this is to play out, then of course we do not have to be alarmed. We do not have to be concerned about bear markets, risk-off moments, demand-destroying events, or even recessions, at least not in the immediate future. But one thing I think we should all be concerned about is if this thing continues to print higher highs and higher lows on the weekly time frame, and at the same time we do get some kind of double top or lower high here and then start to look for a second angle violation, it really is going to be time for me to start getting defensive and entertaining calling a true top, ticking off the first half of this idea, and unfortunately starting to get defensive as the second half of this idea comes to fruition. Absolutely wild times to be alive. You can see my yellow squiggle kind of alluding to the fact that we should probably expect to see some kind of left translation and fail in this daily cycle and then head down towards a weekly cycle low. And of course, if we lose that second angle, as I said a million times, I will have to declare tops. However, if I am going to be wrong on this assessment, okay, if I'm going to be wrong on this idea, the best way to be wrong is to make money whilst doing it. So since we have a daily cycle low here and a hard invalidation position for the trade, I've decided to add an S&P 500 long here, so I have some exposure. And therefore, again, if I'm going to be wrong here about this idea, if we are going to get a big blast off, if there is more legs in this bull market and we really are in the early stages of a bull market, then of course the best way for me to be wrong about that would be for me to make money whilst doing it. The other idea here, and the thing I'm concerned is going to play out, is that we are going to get some kind of lackluster bounce and chop around here, force me to cut my position around break even, and then even start to flip short as we get a second angle violation, where I would expect that big risk off plunge to occur in line with the second half. So I'm kind of playing a long hedge here. I'm hedging my idea, my base case hypothesis, to the long side in case I'm wrong about it, but I am very, very, very on guard here for any kind of lackluster bounce and a rollover, just in case we have to get very defensive very quickly. The Nasdaq did indeed complete its two drives pattern, and if it can break out, you may even see me add a long here again, just on the off chance that I'm completely wrong about this and we are indeed early and none of the things I've shown you today matter. If somehow the unemployment doesn't matter, if somehow inflation is not going to roll over, if somehow PMI is going to pick back up again and a bunch of these recession signals are going to cease to be important, then I am more than happy to just push all of that aside and stay long and strong whilst this thing continues to trend up. But as it stands, I do think we're in the timing window to start to see a slightly more stressed set of financial conditions. So we'll see. And the same is true of the Dow Jones, okay? We've lost that third angle. We should be expecting some kind of bounce here since we have a daily cycle low. But the thing to watch for, again, would be a grind on this second angle and a breakdown, at which point I am more than confident in calling this the top and starting to declare we're entering into a bear market. I'm still rocking with my Russell 2K position from the lows, and all the while we're above this red support, I will continue to push that trade. For the precious metals, they've got a little bit more work to do, but I think they're working on a daily and a weekly cycle here. This will be truly confirmed if we can get a trend line break. We also added a silver position in the members section, so we'll see if we can get a push from there. And for Bitcoin, we continue to rock with two positions. We continue to expect this to be the daily cycle low. I've set the third and final blow off angle here, okay, and hopefully we can get a fourth thereafter in line with what I showed you earlier on. We've already kind of done this, so what I'm hoping for now is that we get one final push and then Camel can start to look to take some profit. Similarly to the stock market, if we can't come swinging out of here for Bitcoin and we start to lose this third angle pretty sharpish, then we are going to have to entertain much, much, much lower numbers. And the last thing I wanted to show you is this Dixie chart, okay? Once more, the Dixie seems to be disagreeing with everyone. I see every man and his dog calling for a lower Dixie, but we have a confirmed 3-year and 15-year cycle low. We continue to chain together right translated daily cycles. And of course, we've got that Wyckoff accumulation, spring, sign of strength, and now emergence to phase E. Now, this move is only going to be exacerbated if the stock market does indeed come tumbling down here. Investors will be forced to sell their risk assets and hide in the short-term safety of the dollar. That, of course, will put a bid under the dollar, and this crazy yellow squiggle of mine just might continue to play out. So I still think there's plenty of risk here. As I've shown you, I'm more than happy to be edging into longs at the moment. I got behind a handful of crypto-related stock positions this week as well, as I started to build some exposure slowly but surely into the new year. I remain cautiously optimistic in case we continue to see some real big grand finale type blow off top moments. But based on everything I showed you, I can only continue to say I've been saying the same things for around 2 years. We've been checking in on the same data sets, whilst occasionally we get wobbles, such as the CPI. This is currently a wobble that we are experiencing with slightly higher than I anticipated inflation. However, it's not the first time we've had a wobble, and the prior wobbles resolved to the direction that we were expecting. So I have a great deal of trouble saying anything other than everything seems to be going, roughly speaking, according to plan. Big economic shifts from expansion to contraction take a long time to manifest, and thus there may still be some further highs left in the markets, hence the current long positions. But I also think we are now at a time where any breakdowns and failed cycles that are observed are to be absolutely respected. So as ever, we're going to continue to stay completely unbiased, unemotional, continue to take this thing one day at a time, and continue to stay on the right side of the market whilst being cautious about future downturns. I'm your boy Camel. I hope you're doing well in life, and until next time, take care from me. All the best. Cheers. Bye.
Camel Finance, he's the man to see, rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame, sticking to his guns in his money game.